Hi, everybody. Welcome to this webinar brought to you by Bursa Malaysia and managed by LifeChamp. Our webinar today is titled How to Read an Annual Report Effectively. So my name is Shinju. I'm the moderator for this webinar. So welcome, everybody. So today, we're going to study how to read an annual report effectively. As an investor, we all need to learn how to read annual report. But because annual report is very thick, we must also be able to read it efficiently, okay, fast and effective, okay. So today we're going to learn how to dissect annual report so we can get critical information from it, and also learn how to read financial statements so we can become an informed investor. So as usual, disclaimer, whatever we'll share on this webinar is only for educational purpose. So in no way that we give any recommendation for you to buy or sell any companies that we mentioned here. So if you decide to make any investment decisions, you're 100% responsible for all your investment risks. So allow me to introduce our speaker. She is Pauline Yong. Pauline is a licensed and experienced financial planner who is certified by Malaysian Securities Commission Financial Planner Representative License, CMSRL, and Bank Negara Financial Advisor Representative License. Pauline is also a course trainer and public speaker at FPAM and Bursa Malaysia. Over 25 years in education, she has accumulated over 50,000 students and conducted over 200 large-scale corporate courses. Other than being a professional financial planner and educator, Pauline is also a best-selling author who has published 6 books on investment and financial planning. Wow. So her articles have appeared in financial magazines such as The Personal Money, Money Compass, and many more. So welcome, Pauline, to our webinar.
Hello, thank you, Shane. Hello, everyone.
Good to have you here. Over to you. You may go ahead and share your screen.
Thank you. So hello, good evening, everyone. Can you hear me clearly? If you can hear me, please type a 1. Okay, that's great. Hi. Okay, let me share my screen. Okay, that's great. Very responsive. Okay, so in today, I'm going to talk about how to read an annual report. Can you hear me? I see that it's lagging a little bit.
Yes, we can hear you.
Oh, okay. So how to read an annual report effectively? So the keyword is annual report. Okay, and annual report is like in the last time we used to receive, investors used to receive a very thick book, and those are the hard copies of the annual reports. But nowadays everything is soft copy now. So I will talk about because today is only 1.5 hours. So I basically, for this course, is a very heavy course. Usually it's about 1 full day. But for me, I'm going to extract the important ideas and concise into a 1.5 hour session. Probably half an hour to do the basic background about financial statements, and then half an hour on the qualitative. So half an hour on quantitative, half an hour on qualitative, and then half an hour for the Q&A session. Okay, so hopefully I can finish everything by 1.5 hours. So we're gonna look at the basics of financial statements. So maybe before I start, how many of you are from are not from accounting background? So that means you are engineer, or you are IT, you are other than accounting background. Okay, how many are you are non accounting background? Okay, so just want to see how many. Is it a lot here? So all engineer, and anybody IT? A lot of engineer here. Any doctors, lawyers? Okay, medical, yeah. Okay, so yep. So I think, yeah, doctor, yes. So I think you have come to the right place, because I will start from very layman terms so that you can understand easily. And without further ado, let's go into it. Okay, great. So first, talk about annual report reports, there are two parts of it. So when you look at the annual reports, and annual reports represent the company financial performance. So it will be, the audited annual reports will be published once a year. And audited means that the auditor will have to sign your accounts. So they have to make sure that everything is according to the accounting rules and also the governance, so that there is no hanky-panky things, okay? So that to protect the investors better. So that is once a year thing. But however, on a quarterly basis, the public listed company, they will issue or they will announce their quarterly earnings as well. So every quarter, end of the quarter, they will announce their earnings results, so that you do not have to wait until one whole year, then only see what was happening previous year. So that will be too late. So nowadays, you can see that every 3 months, the company will have to do announcement. Okay, so so later I will also show you some of the real cases. So I have some slides here. The slides here are some of the terms that you need to know. Then after that, then I will bring you to the website whereby I will show you how to search for those real cases. In today, I will show you two real cases. One is the Gamuda construction. The other one is Vitrox technology. So we'll see later. Okay, so before that, let's talk about financial statements: income statement, balance sheet, and cash flow statement. So these are the three major financial statements. And I will explain these financial statements individually later. And inside the financial statements, out of those three statements, we're going to look at the liquidity and efficiency of the company, see how liquid the company is, looking at the cash flow and how efficient the company to operate the business. And solvency. Solvency is referring to the debt, how much debt they have, debt and equity. Then the market prospects, because when you are analyzing the company, you are actually looking at the future, okay, the future outlook of the company. And then the profitability. So in summary, valuation, okay, of a company, there are three perspectives. You are looking at the historical, you are looking at the current, you are looking at the future. Okay, so there are three perspectives of looking at the valuation of the company, which is the stock that you are looking at. So we look from the historical perspective, and then we look for the current perspective, and then we also look from the future perspective. Now, can you type in the chat which of these, right? A, B, C. Which of these A, B, C you think is most important in your analysis? Okay, type in the chat. Oh, I see you have, I have a lot of C here, which is very, very good. Okay, so that is, in fact, the stock market is about future. Whatever you see now is actually people discounting from the future. Forward looking, yeah, that's right. So I can see the audience are, you know, very knowledgeable. So I do not have to explain too much on the simple stuff. Then I can talk a bit more advanced. Okay, so here we are looking at the historical. Historical means one way to look at it will be the book value, okay, which is the net tangible asset. So very often you see that, oh, the book value or NTA. So this will be looking at the net book value of the company. So basically it's just assets minus its liabilities, or its assets minus all its liabilities. Okay, so that is the net book value, is actual worth of the company. If today you were to liquidate this company, how much will be the final value? Okay, so that is the book value. Now, I wouldn't say for an investor, of course, we look at the future is because of the stock market, because the stock market itself is a future looking, right? But if let's say you are a businessman, Okay, you are a businessman and then you are looking at to buy over this company. So obviously, probably you'll be looking at the book value more than any other things because you want to make sure that you do not buy, overvalue. Whatever you buy is worth. So for example, the book value is 100 million. So then you wouldn't want to spend too much over 100 million just to get it. Of course, you can add certain percentage for the future value, but the book value is important. If let's say you are really like a businessman, you are looking at buying over that company. But of course, as an investor, we will focus on the future value. Okay, can you tell me what will be the current value? What will be the indicator for the current valuation of the company? Anybody? Okay, that's called the share price. Yes, share price times the number of share will be the market value. PE, yeah, PE, anything to do with the price, the current price, either price earning or the number of share, which is the market value. Okay, yeah, market cap, yes, times the number of shares. So will be the market cap. So we are looking at the market capitalization of the company. So straight away, for example, Maybank 100 billion. Straight away, Gamuda is maybe 1.9 billion. And another one is another billion or million. So you're looking at the current price times the number of shares. So straight away you have that idea. Okay, this is the market cap of the company. And the last one is the future value. Can anybody tell me what could be the valuation of the future valuation of the company? Anybody? By looking at the future. Okay, forward PE, still PE. Still, yeah, forward PE, yes. And cash flow, okay, cash flow, okay, we can say that it's intrinsic value. Okay, intrinsic value, which means that you have to discount the future cash flow to the present value. Okay, so it's discount the cash flow. Yeah, that's right. So it's called the intrinsic value. Okay, so in a lot of the value investors, such as Warren Buffett, they always focusing on the intrinsic value, and a lot of people are so crazy about getting the formula for the intrinsic value. But I have to say, formula is not important. What is important is the estimation of the cash flow. This is more important. You can have the perfect formula, but if you were to estimate the cash flow wrongly, then the whole thing is wrong. So it is this estimation of the future income and then to discount back to the present value. And it is this thing that is the most difficult part, because different people will have different ways of looking at the business and then how it can bring revenue to the company. And especially technology companies is very not very clear. But however, you are looking for properties or construction whereby they have a book value. So if let's say book orders. So if let's say you already see the book orders coming in, so those figures are very important, because that will represent the future earnings. Okay, so that is something that it also brings us to looking at which industry we want to focus at, because there are certain industry whereby it is really hard to estimate the future cash flow. For example, the commodities. If you are operated in a commodities industry, the price itself is already a big question mark. So today, what is trading now, it's the future will not guarantee that you will have that price forever. The price itself is so fluctuating. So the commodities itself, when it comes to the estimation of the future value, that will be a challenging part. But however, there are certain industry that are easier to make this estimation. Can you type in the chat what are the easy industry that you can analyze, okay, for a pretty safe estimation of the future cash flow? Which industries? Type in the chat. Anybody? construction, consumer, property, agriculture, banking, consumer. Okay, I see banking. Okay, I will pick banking because anything to do with the consumer, as long as the people, the population is there, and then the income level is always increasing. You know that this industry more or less it's increasing over the years. Utilities. Okay, so these industries and then the industrial. Over the years, these sectors are rather easy to predict as long as your market share and then your branding is strong, consumer branding is there, and over the years, you are sure that your market share is slowly increasing along with the population and the income level of the people. So it's pretty much the same. So you just have to estimate the next year will be times a certain percentage plus times 1 maybe 7% or 10% growth of the revenue. Okay, but so that's why if you look at the Warren Buffett's portfolio, you'll see that he will focus on all these stocks because these are the industries that are easier to calculate the intrinsic value that he can be sure of. Okay, so in investing, you invest in an industry or in some stocks that you are familiar with. You don't invest in certain industries that you don't even know how to analyze them. Okay, so that is speculating. Okay, fintech is considered a growth industry. Technology is also a growth, but technology, there are two parts. One is the consumer tech and one is industrial. So which one? The consumer tech is better for you to analyze because it's consumer. Semiconductor, that is considered a very challenging part because when you're looking at the semiconductor, it is very cyclical. Cyclical means cyclical. So meaning that it's all based on the thing about the semiconductors are that these products are homogeneous. You know what's a homogeneous product? You have the things are same, identical, homogeneous product. So there is no branding unless you can have certain form of a branding of your semi or of your chips or whatever, then you stand a good chance. But if let's say your production is the same as any other competitors, you do not stand any chance, and then the way you compete is a bit of a challenging part because it will be subjected to the demand and supply. Over demand, over shortages. If you have more demand, you have shortages. If you have more supply, you will have over supply. Okay, so that is the danger part about semiconductor. Okay, never mind. So talk about the standards of comparison. So all these financial ratio, financial statements, all these, the number itself, okay, the number itself, it means nothing unless you compare. Okay, always remember, compare. If I just show you a number, the annual revenue is 2 billion. Okay, let's say this company annual revenue is 2 billion. What is this 2 billion to me? Nothing. Unless I compare, oh, what was my last year's revenue? And I compare, unless I compare to my industry, what was, you can have intra-company comparison. That means based on your last year, the year before last year, and then you compare. Or you can compare with your competitors within the industry. Where are you now? Are you among the top leaders, or you are just the normal guys? Okay, so then that is important. And the industrial average. Okay, so that is the idea of having analysis. So when you analysis, you have to make comparison. Okay. Okay, so first, I will not talk into too much about these financial statements, but I just want to give you a big idea because otherwise not enough time. So I will simply give a very, very big concept. So for example, you want to set up a business, okay? So you want to set up a business, and then your business is a cafe, okay? So how much money you think can a cafe setup cost for it? How much is the capital? What do you think? The setup cost for a cafe? Anybody? How much do you think will need to set up a cafe? Let's say you want to do a business. Anybody? 300K, 200K? Yeah, I think about 200K. All right, 300K. All right. So let's say 300K, and this one is like a very nice environment kind of a cafe. So this money, so this is what we call funds. Okay, the funding part. Okay, you need this money. So then you look at the funding part. Okay, the word finance. Okay, when you see finance, it means financing, right? There means some form of where do you come, the money, where are the sources of finance, right? Sources of finance. Where is the money come from, right? Okay, so that is the funding. Where does your funding come from? Okay, so there are two parts. The funding is either come from what? If let's say you only have 100K, then the other 200K you need to borrow. Okay, so therefore there are only two parts. One is loan, the other one is capital, which is your equity. Debt and equity. This loan is also the debt and equity. Equity is your capital, so it's your own shareholders' money. So if you want to do a business, you will have to look for how to raise funds. So same thing in a public listed company. For any public listed company, they can raise funds in two ways. Okay, one way is through their own shareholders, so equity funding, and you can do rights issue, you can IPO, you can, as long as you are getting money from your shareholders, it is under equity financing. Okay, and then if let's say you are looking at debt financing, so that means you are borrowing money. So therefore, you will have to look at this as a form of a liability. Okay, so these are the terms in the financial statement that you probably will run into. So here I'm drawing a balance sheet here, whereby the right-hand side is the liabilities. Okay, will be all the loans, liabilities. Okay, and then here will be your equity. So we are looking at the right-hand side here will be the sources of funding that will fund your business. So then if you're looking at 300K, then probably you want to borrow 200K and then 100K. And then the money that you come, and then you have to buy the equipment. You have to buy the fittings and fixture, okay, fittings, all the tables and chairs and all these furnitures and things like that. So then all this will spend about, let's say 200K. Then the balance, you put it in your bank, okay, your bank account. So 100K. So therefore, you are looking at the money that you come from this funding here is actually to finance, to pay for your assets. So these are called assets. Okay, and these are all the assets, and then which means that this balance sheet has to be balanced. Okay, meaning that this balance sheet, the assets is equal to liability plus equity. Assets is equal to liability plus equity. Just now, we were looking at the net tangible asset, right? We said that the net tangible asset, or the book value, is equal to asset minus all your liability. So when you look at the balance sheet, so when you see that the assets minus the liability is in fact equal to equity. So if you want to know the book value, the net tangible asset of a company, of a public listed company, you go direct to look at the equity part of it. under the balance sheet, you go direct to the equity part, and then you look at it, and that is the amount of that net worth of the company. Okay. Okay. Then what is the link from this income statement to the balance sheet? Okay, there is a link. The link is through the profit. Okay, because under this equity, right, there is one section here is called accumulated profit. So all the accumulated profits will be added onto here. So for example, after 1 year, your accumulated profit is 20K, then you added 20K. Okay, and then your bank balance also increased by 20K. So then your overall is increased by 320. Okay, so it's balanced. Okay, so that's how it is linked. So if let's say you are making losses, okay, if you are making losses, then what happened? Then this will be negative, negative, negative. So is it possible that one day this whole thing become negative? That means when it comes to the net tangible asset, supposed to be positive, right? Equity is supposed to be positive, right? So is it possible that one day you have so much of a losses that your net tangible asset, right, become negative? Is it possible? Type in the chat. Yes. Okay. Yes. So example. Okay. Can you give me one example? What is happening? Asia. Yeah, that's right. Okay. So Asia is having a negative net tangible asset. Okay, so here we are looking at the situation whereby if it's negative, the chances of going into the PN17 is very high. Okay, all right, next. Cash flow statement. So cash flow statement is a statement whereby it registers all the cash flow of the company. Now, a lot of people just now have given me is very important, because whatever in the income statement, okay, whatever in the income statement, it is looking at some of the non-cash item as well. For example, accruals, all those accounting stuff like accruals, depreciation, all these non-cash items are included in the income statement. So in order to take out all these non-cash item, then you want to show the true cash flow of your company, then this will be the statement to see the cash flow. Okay, so under what kind of a situation you will want to look at this cash flow statement? Okay, each of these financial statement, there is a function. So for example, if you are looking for the accumulated profit or the equity or the net tangible asset, you look at the balance sheet, which is the statement of financial position. Okay, somebody gave me looking for dividends. Yeah, that's right. So when you look for the cash flow statement, right, you are looking for, do I have enough? Does this company have enough of cash flow for dividends payment? Okay, yes. So for the investor's point of view, they want to see how much is available for dividends. So where can we see? Okay, so there are 3 sections here. You have this cash flow from operations, cash flow from investment, and then cash flow from financing. Which one is to see the dividends, money available for dividends? Which one? Anybody? Operation? No, not operation. So it will be this investing. Okay, so the money after you've got your the cash flow from your operation, and then you minus this cash flow from the investment activity. So the leftover will be the money that is for the dividends paying. Okay, so whatever leftover will be for dividends paying. So therefore, whatever the money you get from the operation minus whatever investment you have, and then the leftover, these are the money is for the dividends. Okay, so you will be operation minus the investment, and then the leftover will be the available for the investor. But however, it's up to the company to give out dividends. There is no like obligation. It's depending on their dividend policy. So it's not like they have to give you that dividends. Okay, it's not. It's according to their dividend policy. So in this case, we are looking at dividend. Okay, under the financing activities. Okay, financing activity. You see this item here, dividends. So there is a dividend taken out from the financing activity. Okay, so if let's say you are looking for dividends, and then you come to this financing activity and see if there is any dividends given out or not. Okay. Okay. Just grateful for any dividends nowadays, right? Especially when a recession. But I can tell you we are recovering. Okay. So whatever you saw last year, the year before last, it will be ending. So looking forward, you should be looking at recovering. And then if you haven't jump into the boat, please jump into the boat now. Okay. Otherwise, the boat will be going off already. And then all the low levels that you saw last year, the year before last year, it will be like bye-bye already. Okay, so you have to catch on to the wave. Okay. Okay, so half an hour. Okay, so after the quantitative, right? So all these are quantitative. Okay, so pirate ship. Okay, no, not pirate ship. Okay, it's a big cruise. Okay, it's a cruise that can fly you to the ocean, the big ocean. Okay, so here let's recap the quantitatives. Okay, because supposed to spend like 30 minutes in the quantitative, so now it's about 35 minutes. But anyway, we recap what we have learned in this quantitative, meaning numbers. So in this numbering section here, we learned that in the annual reports there are two parts. One is the numbers, which is all these financial statements and everything, and the other part is the qualitative, which is looking at the next part, which is looking at the management analysis and also the future outlook of the company. So under this quantitative analysis, we have learned that there are three statements here. The three statements are the income statement, whereby you look at the profitability of the company, how profitable the company is, income statement. Then the next one is the balance sheet. Okay, the balance sheet will be the statement of financial position. Okay, financial position. So this financial position will be looking at the net worth of the company, the net tangible assets. So by looking at the equity part, okay, so you can see assets and then liabilities, and then the equity part will be the last part here. So by looking at the equity, you can see the net tangible assets. Then the last one is the cash flow statement. For the cash flow statement, you are looking at the cash flow of the company. So by right, we want to see that the cash flow from operation is positive figure. The cash flow from invest, because okay, why do you think operation has to be positive? Anybody? Why do you think the operation, this one has to be positive? Operation meaning that the way you look at it is like your working capital of a company. Got profit, yeah. Because if you look at the working operating activity, right, it's actually looking at the way you run your business, from your buying your inventory, raw material, and then produce it. And then after you produce it, you turn into your stock. And then after that, you sell it to your customers. And then you collect money from your customers. After you collect money from your customer, you pay your suppliers. And then the money goes one round like this. So it's your working capital. So meaning that you need to have some money to buy the raw material first. Then after that, you collect money. When you sell your goods, right, you collect money from your customers. Then after you got the money from your customers, then only you can pay off your suppliers. So then the one round is like that. So if let's say this one round, right, you are having negative, so meaning there is something really wrong in your operating system. So you are having a negative cash flow. That means your money collected from your customers is not enough to cover for your suppliers. So that is a a serious problem. Okay, so we want to see positive. So negative cash flow from, okay, wait now. Okay, so here we are looking at cash flow from investment activity. So in this cash flow from investment activity, do you want to see a positive or a negative? Type in the chat. Cash flow from negative, very good, because we are looking for investment. So you always hear people look at capital expenditure, capex, okay? Capital expenditure. So this capital expenditure, where do you identify? It's from here. So you want to see, oh, I have invested in purchase of the properties, plant and equipment is how much? So it's negative. Okay, so whenever you expand your business, you buy more property, plant or equipment, machinery. So these are good things. So that means your company is doing well and then you are expanding. So we want to see negative here. So just now was positive, right? Then this one is negative, right? Then how about this one? Cash flow from financing. You want to see negative or you want to see positive? Okay, type in more answer. More answer. Okay, that's a mixture. I see 50% say positive, 50% say negative. Okay, so the answer is we want to see negative. Okay, you think this is financing. Remember just now we say financing, looking at the two sources of finance is either equity financing or your debt financing, right? So when you have borrow more money, money coming in or coming out when you borrow more money? Positive cash flow or negative? Yeah, it's in. So it's positive. So that means that if you want to see positive, that means you are borrowing more money. And then another thing is that when you want to pay off your loan, okay, pay off. So when you pay off, is it positive or negative? Negative. So, and also when you want to pay your dividends, also another negative. So in fact, if it's a healthy company, right, you should see negative here. So the positive in the operating should be able to cover these two negative here. If it's a healthy company. Okay, that's for the cash flow statement. So let's go to the quantitative. Negative investing should more than negative financing. Well, it depends. As long as overall the positive from the operation is able to cover these two, that's fine. You do not need to see these two among the negative, which one is more, which one is less, not necessarily, okay? As long as the positive is able to cover these two negative is good enough. Okay, so then we have done this part. So let's take a look at the qualitative. Now, when it comes to qualitative, usually this is how an annual reports will look like. So this example is a consumer, okay? I show the consumer one because we start from the easiest sector, which is the consumer. So look at the consumer annual report. In this case is Hap Sing, okay? I show you the Hap Sing one. And in the first few pages, usually they will show you their corporate structure. So in this case, you see that Hap Sing is this, and then following by subsidiaries. So these are the subsidiaries, and then it is 100% owned, these three subsidiaries. Okay, so that's a corporate structure. And the important part about the annual reports is this management discussion and analysis. Okay, so if you want to read your annual report effectively, that's the theme of today, effectively. So you go straight, direct, look at the annual report, straight go to the management discussion and analysis. Of course, you have to look at the numbers as well. The numbers, see whether overall it's a gain or, you know, you have more growth or less growth or, you know, that kind of thing. But after that, straight into this management discussion and analysis and read line by line. The management discussion analysis, you have to read line by line, okay, because all the information is important. So basically, they will tell you their products and their branding. They'll give you some background about their company, and they will also because from their products, you can see the segments, the product segments that they are operating in. Because in a public listed company, usually as a company is growing, they will diversify into other industry as well. So you wouldn't see one main core business. So there is, but then it will be natural if they have other investment as well into other sectors or industry. So for example, in this case, yeah, they tell good story only. Well, they have to be transparent because it is their duty to bring out the positive and the negative part about the company. They have to be transparent. So they will say all kinds of things, including negative as well. So you can see that this biscuits manufacturing company is producing biscuits. They also venture into beverages, and they also become like a distributing agent for some of the biscuits or the rice crackers. Okay, so they have all these different business segments. So you can see that these business segments, right, although it is different business segment, but however, they are under the same category. There are certain public listed companies, right, they will actually diversify into a totally different industry. For example, okay, in a property, you diversify into producing gloves. Okay, so that is totally different. Or if let's say you are looking at the plantation, then you diversify into properties. This one maybe it's there is some relationship because plantation companies have a lot of land. So you clear the land, convert the agricultural land into commercial land, then you can make money out of your land. And some of the construction company also diversify into the properties. And this one we can also understand because construction, right, is all those material. So you can use those material to build a house as well. Okay, so it's related. So that's how you can see that somehow some of them are related, and then some of them are non-related segments. Okay, yeah. So here will be the biscuits and the product range. Okay, different 3 segments. So basically into 3 subsidiaries. Okay, 1, 2, 3. And overview of their business. So they will say that, okay, our company have a slower pace. Okay, the growth is of a slower pace. You see, they are very honest. The revenue grew by 5%, and the profit after tax, however, decreased by 10%. Okay, so these are negative things, but then they have to say it because they have to say the truth. Okay, then no selling price. Okay, so that means that when you see your revenue increase, but your profit is reduced, so something is wrong, because usually we want to see that your revenue, okay, increase, and then your profit, okay, also increase. So then if that is in tandem, so that means that increase revenue increase 10%, profit also increase 10%, that is healthy. Okay, but however, if your revenue is increased but your profit is decreasing, so that means something is wrong. Okay, so because after all, the revenue, you have to minus your cost. So is it that your cost is out of control? Okay, so let's see. So we said that there is no increase in the selling price, but however, the price of the raw materials had increased. You see, the palm oil prices have increased, and then the sugar, milk, and all this all increased. So therefore, they have a lower profit. Okay, so that is looking at the line by line. And if you look at it, they will talk about the outlook and all these things. So you just read on. So then another thing, they will talk about whether they have exports business or not, because in Malaysia, if you just do the Malaysian business, your revenue is capped at a certain level. However, if let's say you have exports revenue, that will be good because you also earn US dollar. Okay. So here we are looking at exports is about 30%, and then your local is about 70%, which is quite a reasonable ratio. Okay, then capacity. Another thing about the production, because all these are manufacturing plant. So manufacturing plant, you have to look at their capacity utilization. So meaning that how much of a capacity utilization this company can achieve. So about 82%, I think is very good. Although if you have full capacity, that means your business must be really good. But if let's say you have under capacity, so that means something is wrong with your orders, business, and things like that. So you look at this capacity utilization, okay, for a manufacturing company. Then they would usually in the annual reports, they will give you all these 5 years, all these 5 years, and then you can see the trend if it's going up, or going down. Okay, then they will give you some financial highlights, and basically how you look at the book value, market value, and intrinsic value. This one I have already covered. Okay, so basically book value will be the net tangible asset, the market value will be the market cap, and then the intrinsic value will be the future discounting cash flow. Okay, so important part here. Let's take a look at the, when you do analysis, okay, on the annual reports, the very first thing you need to be clear is the what kind of a sectors or industry you are operating at, what kind of industry or sectors. So this is the very first thing that you need to get yourself clear and familiar. So in our Bursa Malaysia, we have 13 sectors. Okay, 13 sectors, and these are the 13 sectors. Just now we already say that the easier one will be the construction, consumer, easy to analyze because all this, they have the book order, they have the this is based on the population and the income level, and then the banking and industrial and property, REITs, and utilities. Okay, so these are the easy ones. So if let's say you want to be safe, and then you just want to invest in some consistent safe stocks, these are probably those few sectors that you should be looking at inside your portfolio. Okay, and however, if let's say you under your portfolio you have one small section of your money, maybe like 10 to 20% of your overall portfolio money, you want to allocate into high growth or speculative, okay, it's good. Okay, it's good. It depends on your risk appetite, of course. If let's say you are looking at, you want to generate that extra income for your portfolio return, extra return for your portfolio, and you do not want to always looking at that you know too safe return. There's no capital appreciation, and then the dividend is consistent, so you want capital appreciation more, then perhaps you can go for technology. Maybe nowadays, this year the theme is commodities, right? So maybe this year, for this year only lah, commodities, energy. Okay, then technology is when you know that it has to be you have to be careful, because technology, there are so many different industries. So the one that I mentioned, that one is semiconductor. So semiconductor, you have to be careful, this one. Okay, so because of the cyclical, very cyclical. And however, there are also other technology companies, like for education purpose, not for stock recommendation. For example, MyEG is for software based, right? Whereby it's a platform for you to do payment, and they are not related to the semiconductor. Okay, so therefore this one is safer in the sense. And then also another one like equipment kind of company, which later I will show you. Bring one case study. It's not recommending, okay? I don't mean to recommend, but I want to just show you what is happening, okay? And for education purpose. So sorry, not equities, equipment. Okay, equipment. So equipment will be VTROPs. Okay, equipment. They are producing equipment and all those. Later you will see their annual reports. They have those pictures inside there. So these will be those growth companies. Okay. Yeah. Okay, I see a lot of questions, and yeah, so I say that the semiconductor have to be careful, and the EMS, VS, all these, okay, all related, have to be careful. Okay, EMS, all this. Whereas the ATE like equipment, they are safer. Okay, safer, but of course they are also related because some of them involved in the test and burn. That means they will test the semiconductors, but however, some are more to the producing the equipment, robotic arm, and all those things. Some are really producing those things. So you have to be looking at the annual reports to see what are the products that they are selling. Okay, so that is very, very important. So as long as the products that they are selling involve certain form of intellectual property, IP, intellectual property, they are safe. Okay, meaning that people are willing to pay higher price for this intellectual property. If let's say they are producing generic homogeneous product, they are not so safe. Okay. Yeah, OSAT will be those Inari lah. So those are the semiconductors, so you have to be careful about it. Okay. So okay, so here some of the examples here are the airline industry. So airline industry, what are the factors that you need to look at? So when you analyze a company or annual reports, so these are the terms that will be inside the annual reports that you have to be familiar if really you are buying the Air Asia share, let's say. Okay, if let's say you are buying the Air Asia share, then at least you need to know what is the load factors, what is the cost per available seat, the ASK. All this will be written in their annual reports. So therefore, you will have to see, okay, what is their capacity utilization, 80%, 70%, or 50%. And then what is the cost per available seat kilometers? In the US, it's called miles, and in here, it's called kilometers. Then it's based on how much of a calculation is your operation cost divided by your available seats kilometers. And then your unit revenue, unit cost, or this debt to equity ratio. So these are important parameters or factors deciding whether this airline stock is good to invest or not. Okay, you look at this. Okay, some of the annual reports that did not show you the capacity, yeah, only show the total production. And if there is if they didn't tell you the capacity, that means you can't get those information. Then you probably will have to read analyst report, because sometimes some of the analyst report, right, those analysts, they really go into the company and then do a site visit, and then before they write the report, so they will have more information. So because you are not the analyst, right, you are just an investor, so we do not have that access. So then we need to look at the analyst report. Okay, so let's talk about the banking. The banking, basically, if you are investing in the banking stock in January, I think you are on the right track. So meaning that you see that your banking stocks are increasing. Okay, and so what are the things that we need to look at? So we need to look at the loan growth. When the economy is recovering, we should see loan growth. Okay, and then the gross impaired loan ratio, whether they have certain loans that are in question. Okay, for example, okay, a certain name loan is in trouble. Okay, so therefore, if let's say you are the bank who are the underwriter for this company, big company, and who is suffering from that problem, then you probably have to give provision. Okay, you have to provide a provision for this GIL. Okay, so it will affect your P&L. It will affect your profit. So if let's say your provision is a lot, then it will affect a lot. Okay. So for example, okay, no, not for recommending or anything. For example, the M Bank is involved with the 1 MDB. Okay, and then also some other banks also involved with the energy stock loan. Okay, and certain things like that. So you have to look at when did they make the provision, did they already made the provision, and then in the future no more effect. Okay, what is the situation? Then you have to find out. Okay, yeah. So but anyway, let's hope for the best lah. Okay, Tier 1 capital ratio. Okay, because in the banking industry there will be Tier 1, Tier 2, and Tier 3. So basically, the Tier 1 will be looking at their core assets. Okay, and then because in the bank they also receive money from the depositors like me and you, we deposit cash into the bank. So therefore, this cash deposited into the bank, right, it's not really the bank's you know, their asset doesn't belong to the bank asset. It's actually, but however, it is considered Tier 2 or Tier 3 kind of a definition. Okay, so therefore you will see that the assets and the money that are coming in, although normally we would think that, oh, those are cash, should be the asset, but for the bank it's not, it's the liability. Okay, yeah. So telco, okay, so all this, okay, now I want to share with you the true case. Okay, otherwise, okay. So so the first one I want to talk about is this Gamuda. Okay, so usually when you want to do certain annual report analysis, you will have to go to the company website, and then under the company website there is this investor relation, and then you click into that for investors. Then you'll see that these are the financial highlights, and then the latest earnings, quarterly earnings. So here you see that it is second quarter results for the financial period ended 31st of 2022. Now, a lot of people, they have some confusion about this quarterly thing, because they will think that, oh, first quarter, isn't it end of March? And then the second quarter, isn't it end of June? Okay, but for the public listed company or any other companies, as long as you are having a company, you will see that the quarter, the financial year end, is not always ending in the December. Yeah, correct. Yes, it's depending on the financial year end. Okay, so the financial year end and the calendar year end, there is a difference. So let me type in the chat there. So there is a difference between calendar year versus the financial year. Okay, so that is a difference. So a lot of people who have no accounting background, you will not understand what is the difference. So I'll explain here. So calendar year, no buy call. I'm not recommending. I am just for education purpose, because I like the way they present to their investors. Okay, it's the presentation that I want to share. Okay, so here I'm looking at calendar year, means one whole year starting from January, and then the year end will be December. So that's calendar year. So some company, their financial year end also same as their calendar year end, meaning that their financial year end is December 31st. Okay, so that means there's no problem. Okay, however, in this case, Gamuda is having the financial year end differently. So can anybody calculate a little bit and tell me when is the financial year end? So this is already second quarter. So when is the financial year end? Yes, so it's in July. Okay, so July ending, then the new month will be August. August, September, October become first quarter of the company first quarter earnings will be August, September. So their first quarter become, okay, first quarter is equal to August, September, and October. Then the second quarter will be looking at ending because you have November, December, January. So the second quarter will be January 31st. So yeah, okay. So therefore you are looking for this second quarter ending in January 31st. Okay, let's see. So the way I like the way they present is because, okay, if you were to look at the annual reports, it will be too late because, you know, it will be outdated. So if you were to look at this quarterly, it will be very latest. For example, the January 31st, usually will be 2 months later, will be March. So March, they will announce it. Okay, so let's take a look at here. There are two here. One is financial statement, and then one is investor briefing. Now, not all the public sector company, right, have this investor briefing. Usually, they will just have the financial highlights, okay, which is something like this, which is all numbers, all boring numbers, no, nothing. Okay, so you wouldn't want to read all this very boring stuff, right? So then you will have to click the investors briefing. That one is better. So this is investors briefing for the second quarter 2022. Company itself determine, yeah, is when do they form the company. Let's say they form the company in July, then of course they will make the year end in July. Okay, so it depends on which month they can change also. So for example, they can change. If let's say I don't want to be in July anymore, I want to change, so they can make a request to change that as well. Every day have to go through their accountant, okay, or audit. Okay, so here we are looking at Gamuda on the March 23rd. They have this PowerPoint, okay, for their investors. So you will see that key highlights. So it's so much easier to read these more efficiently and effectively. Okay, so it's really effective if you do read this rather than this. Okay, this one is like you will take hours and hours, right? But this one is like so easy in point form. And the thing is that the first thing is the revenue must increase. It does increase 44%. And construction is rebounding strongly, and the order book triples in strong start of the year. And looking, they have a record of 10 billion already outstanding, book order of 10 billion, and they are now targeting at 20 billion order book by financial year 2023. So that's amazing, right? So another thing is the MRT3 also in hopefully hopefully also in the line. And then they also say that the properties pre-sales also beat the target. So although the properties, as you can see later, their revenue segment is a small part only. The major part is still the construction. They have 3 major stream of revenue segments. So the construction is the biggest revenue, biggest pie. Okay. Then here we are looking at their income. All this I don't want to read. I will go straight to the numbers. Okay, segmental profits. Okay, so here if you want to be effective, you also cut into this segmental profits straight away, so that you want to see that which of these services or products are contributing to the overall profitability. So we can see that the big segment is from the construction and engineering, which is 124 million, which is 124 million. Okay, then which is a big jump from year on year. Okay, big jump. Then for the properties, it's even biggest jump, because this was 9.1, and then this is like 500% of a jump. And then you have this concession. Concession is also like equally important with the properties. Okay, same form of same revenue, which is around 60 million. Okay. Yeah, so not a stock recommendation. I'm just I like the way they present, because if you can see the investor briefing, right, it will save you a lot of time. And yeah, concession of highway, yes. So you will see that a lot of all this save a lot of time. And then if let's say you have also read other analyst report, you can also save a lot of time. Okay, so these are the shortcut way, rather than you yourself doing the hard calculations by yourself. So this will take hours, okay, and may not get anything, because these are just numbers. So you still need all this information. So another thing, let's see, here. So then they will also list down to you that say 10 billion, right? So you must be curious, where are these 10 billions come from? So these are the listing order book. Okay, so you can see their completion year important, because if let's say majority are completing this year or next year, that means there is something worrying. Okay, then the updates on the properties. And I think the most important is their construction, because that is the bulk of the revenue. Okay, the properties and the concession are small revenue, okay, compared, but still good revenue lah. Okay, so as you go on, right, you will see that, okay, so monthly, okay, so all this thing, okay, so it's very good. Okay, the presentation. So now I'm going to show you another one, which is this VTROX. Okay, so also not for stock recommendation. It's just that I want to show you why sometimes when you are looking for annual reports, you probably have to wait for a long time. You see this one, the latest annual report in this website is the 2020 annual reports, which means that the 2021 should be coming soon, but then not in yet. And now we are in 2022, and the financial year end is December for this company. So which means that if you to read the 2020 annual reports, it's a bit outdated. Okay, so you definitely have to read their quarterly report. So where do you get the quarterly report? Usually I will look at the, excuse me, I will look at the investor, iInvestor 3 or Bursa Bursa Marketplace. Okay, so Bursa Marketplace or iInvestor 3 also can. So in this case, because just now I was trying to access to the Bursa Marketplace, but it looks like the website is having some problem loading. So then I will show this the i3 investor. So under the financial, you will see that the latest are out already. Okay, so the latest is here. The latest quarter is 31st of December, which they announced on the February 25th. So the next announcement will be this month, 20th. Okay, so they will announce the quarterly first, although the annual reports will take some time, because usually by the time when the auditor finish everything, and then you will have to send for the, you know, the printing. Now there's no printing, but at least you need to do the layout, and all this will take some time. So it will take another 1 month or so. So I think it will be coming out soon. So here, let's take a look at their annual reports for 2020. Okay, so what are the things that you need to see? So basically, in this annual report, they will tell you their core values, and then their all this their stuff. And the important thing is, okay, financial highlight at one glance you will see. But important thing, I usually go straight to the management and discussion and analysis. Okay, I'll go straight to here. So you will see their management discussion, okay, what are their things, and financial position, performance, product innovation. Okay, here, product innovation, because this is a technology company. So we want to look at their product innovation here. So here we are looking at their new products release. Okay, so they are producing what? They are producing something that can do with deep learning for machine vision. Wow, all this complicated stuff. Although I do not know too much about this technology stuff, but I think these are great stuff. Okay, so meaning that they are really for in front, in ahead of the others. Okay, ahead of the other players. So that means they are ahead. So that's why I want to show you that it's important that you, if it's a technology company, definitely you want to see that they are doing something you know, in ahead of other people. And then you will see that metaverse, yeah. So here there is like this one, there is a picture of this. So they are looking for they are also producing this kind of a machine equipment for customized. So if let's say you are a company in the manufacturing and then you need this form of a machine, then you are able to buy from them. And they also export to other countries as well. So not only Malaysia. So that means they are looking for revenue all over the world. Okay, so that is the great part about this company. So its revenue source is from all over the world. So here are just the equipment. I show you the picture. And then there is one part whereby they will tell you their revenue from, I don't know how many countries. Let's see. They will spend the R&D, you see, they will spend the R&D into all this research and development. Sales distribution by country. Okay, this one. So you will see that the sales distribution by country. Okay, so these are the things that I usually look out for in annual reports. Like if let's say this company it's doing something well, so you want to see how much is actually selling overseas. So you can see that actually 25% only is in local and 75% is all from overseas. So the revenue is USD. So you can see that they're earning US dollar. Yeah. So yeah, definitely you have to spend some time to read all these line by line. You see, it's not like you invest in a stock, just listen, and then you buy the stock. No, you have to really understand the business by looking at their annual report. So these are very in-depth analysis whereby you will really see what is happening. You just need some time to spare to give your, because after all you're going to invest for some time. It's a long-term investment. It's not speculative. It's speculative, of course, you just look at the chart, technical, and then you just buy or sell. But if it's you are looking for long term, you definitely have to look for these things. Okay. Yeah, definitely a lot of homework. There's no shortcut, no shortcut. And then also just now I wanted to share with you is this this, you see the date here, the date of briefing, March 23rd, and then you look at their share price. March 23rd is here. March 23rd. Okay, March 23rd. Yeah, around here. So March 23rd is around here, whereby it was around 334. Okay, 330. So when you are announcing it, wow, everybody see, wow, good profit, then the share price jump. Okay, so all these earnings, you need to take care of the date of announcement. All this, especially if you are holding this company, you need to take care of the date of the announcement date so that you can watch out for the announcement and see if there is any significant changes in the profit or not, because the profit will affect the earning per share, and the earning per share will affect the PE ratio, and the PE ratio will affect the current share price. You see it? Okay, I write it down. So the earnings will affect the EPS, and the EPS will affect the PE, and the PE will affect the current price. Okay, so the link is like that. So that's why it is very, very important. Yeah, fundamental is still important, because after all you are investing for long term. It's not like you are speculating. If you are speculating, that will be another story, because this is value investing. Okay, So I think, let me do some wrap up here. So let's recap. What have we learned? We have learned so much, right? From the numbers, all the financial ratio, cash flow statement, and then to the qualitative analysis, whereby we look into the annual reports and the investors briefing, and then to try to come up with some sort of a future outlook of the company, because it's from the annual reports and the investors briefing you can see the future of the company. Okay, so which is yeah, and also not forgetting the sentiments of the investors, because if let's say the company is announcing the good results, but however in a very weak sentiment environment, so then the share price will not go. Okay, but however, if let's say you are looking at a good environment, in the sentiment is good, and then with this good earnings, then the share price will jump. Okay, yeah. There are many factors affecting the stock market. Political influence, the sentiments of the market. The sentiments include the US stock market. So usually Elon Musk tweeting, and then many. Okay, so all these are, of course, the war now. The current situation is the war now, and also the interest rate. But however, if you to notice, right, the stock market usually before the things come, right, the stock market will be anticipating it, and then it will be down. But once the thing is done, become a fact, the stock market will jump. Okay, because it's over already. So in the first quarter of this year, we see that the stock market actually became very volatile because of the interest rate high, and then because of the war. So it became very volatile. But usually, okay, usually the stock market will take about 3 weeks to digest, especially the US stock market will take about 3 weeks to digest. So if you to look at the day of the Russia invade Ukraine, it was on the February 24th. Then you plus 3 weeks, February 24th, and then you plus 3 weeks, that is around the mid of March. And that is actually the bottom of the US stock market. Okay, so that's why when you are looking at those very important news, like disaster or this kind of important news, usually the market will take about 3 weeks to digest. So after 3 weeks, then it will start to recover. Okay. Yeah, February 24th. And then when after digestion, then they think that the war is like it's going to end, the oil price will come down. Okay. All right. Creative accounting might be misleading, yes. Okay, because when it comes to the book accounting, there are so many creative accounting whereby you can delay recognition of certain costs, or you can bring forward or bring delay. All this you can do a lot of creativity, and especially depreciation, all these things. Okay, so therefore in a certain way, this kind of a manipulation is still okay because it's within the rules. Okay, so unless it is like you do a false invoice, that one is illegal, so that is a crime. Okay, so I have to be careful. Yeah, so you have to be careful, and then especially whenever you see that there is any form of accounting fraud or anything, then you have to straight away sell the share first, and then only you observe. Okay, because especially when there is a gap down on that day, usually when there is a gap down, depending on the gap, like it's a big gap, like 10% gap down, immediately you just sell. You do not need to discover what is going wrong first. Okay, you see the gap down 10%, sell. Okay, no question asked, no need to wait and see. Okay, so usually that is the thing, because after the gap down, right, subsequent days or weeks, it will continue to go down. Okay. Yeah. So I think any other questions? Okay, let me browse through, because as I was yeah.
Pauline, there are actually quite a number of questions on Q&A.
Oh, I didn't see that. What's the difference between
the first questions by THTO is, what is the difference between profit after tax and comprehensive income in P&L, which is more important?
Okay, yeah. So if you see the word comprehensive income, that means that you are actually involving some exports business whereby you involve some foreign exchange. So therefore there will be some form of hedging, especially if you're looking for Asia involve a lot of hedging, then there will be some unrealized profit or unrealized loss. All this will be captured in the comprehensive income. Okay, so will be some form of investment.
The next question is, in cash flow statement, we often see that, operating cash flow before change in working capital and also net cash flow from operations. What are the differences?
Okay, operation cash flow. Okay, so when you're looking for operation cash flow, that means you are looking for the you get the answer from the net profit. Okay, so then after you got the answer from a net profit, remember the income statement is you have all the accruals and all those accounting. So therefore, a lot of non-cash items. So when you want to put it under the cash flow from the operation, you have to minus those non-cash item and then add back those so that means add back depreciation and then minus all those accruals and things like that. So therefore, you will have this kind of it will affect the this adjustment. So this is what we call adjustments. Okay, yeah. Okay, then
okay. And then we often hear that people want to be more alarmed. Okay, when it comes to trade receivable amount, could you explain to us why is trade receivable important?
Okay, so when you are in a business, you will have accounts receivable and then you have accounts payable, right? So when you receive money, meaning that you are receiving money from your debtors, okay, that means your customers. So so of course you want to make sure that these customers are valid, and then sometimes you can, when you want to detect accounting fraud, probably you will see that, okay, how come these customers are owing the money for so long, and then something like that. So therefore receivable means that your debtors, okay, your customers. Okay.
Okay, thank you. So Shukri would like to ask, what is the difference between group and company in the financial statements? Sometimes we have group and financial, right? Which to focus on when we want to analyze the financial statements?
Okay. Just now, when I said that a lot of the public listed company, they have many business, like they have their own core business. For example, Gamuda, they have their own core business. But at the same time, they also have subsidiaries that are operating in other segments. So therefore, group is a whole group of companies of the company that involve other subsidiaries as well, that you have a major share holdings of the company.
Okay. So the last question that we can do today is, what's the difference between basic and diluted earnings per share?
Okay, so the basic means that you are looking at the number of shares, because all these per share, earning per share means your earnings divided by the number of shares. So if let's say you have a corporate exercise, you have a rights issues or ESOPs, all this will increase your number of shares. So therefore, when it increase the number of shares, then you divide it by more shares, then you diluted the earnings. Okay, so it's diluted earning per share. That's because you have corporate exercise.
All right, so thank you very much, Pauline, for addressing all the Q&A on the panel. Yes, I think we have a very engaged audience today. I see that the chat group is very active. So thank you so much, Pauline, for doing this engaging session for us.
Okay, thank you. Thank you so much. I see a lot of questions, but I cannot answer. Yeah, thank you so much. And then hope you guys learn something today. Okay, thank you.
All right, so here is our Bursa Academy. So if you want to know more about Bursa Academy, you can go to www.bursaacademy.bursamarketplace.com. It is a resource. It is an academy to provide you with a lot of investing resources, be it in quizzes, in videos, recordings, articles, for you to learn more about the market, the products, as well as investing strategies. So for our next webinar, it is titled 组合与风险管理. So as the name suggests, it is going to be in Chinese. So we're going to conduct this session in Mandarin. So it's happening on 11 April 2022, Monday, next Monday, 8:30 to 10 o'clock. So I've just given you the registration link. So if you want to learn about how do we do portfolio and risk management effectively, please register for our next session, which will be conducted in Mandarin. So in this session, we'll explore how do we do proper portfolio management. What are the 3 steps in doing portfolio management? All right. So with that, thank you everybody for tuning in to the sessions today. And thank you, Pauline, for doing this segment. And yeah, see you again in our next webinar on Monday. All right. Hello.
Okay.
Bye, everybody.
Okay, bye-bye.
Have a great rest of the day. Yeah.
Bye-bye.
Who is the speaker? The speaker is Ivers Ui. Okay, the next speaker is Ivers Ui. Thanks, Pauline.
Bye.
Good night, everybody. Okay, we will send the recording to you. If you have a record for today's class, right? We'll send recording to you tomorrow. Okay, so see you all next time.